I'm Morag and I run a business called Northwest Numbers Limited. We provide bookkeeping and accountancy services for small charities, not-for-profit, startups and businesses. Sorry, my hair is just going to pieces. This is 3 Minutes with Morag, where I am discussing basic principles of accounting. Okay, so this may not be anything your accountant ever actually talks to you about, but basically there are essential rules and concepts that govern accounting, and the main and the process that on how we record, analyse, verify and report position of a business. And these 5 principles are revenue recognition, historic cost, matching, full disclosure and objectivity. So I'll explain each of those separately. Okay, so revenue recognition, basically what we're saying there is the gross input of money, inflow of money, cash, receivables and other considerations that arise in the course of your ordinary activities, like sale of goods, services, use of the resources, all need to be recorded in your financial statements. Sounds obvious, but that's why it's a very overriding basic concept. Okay, so the next one is to do with It's to do with historic costing. So historic costing is to do with the fact that when we record an asset, income, expenditure, any kind of transaction into your accounts, it's based on the cost or income, the value at that date. It's nothing to do with, it's what you've actually paid or received for it. It's nothing to do with potentially, so for instance, a building, most buildings, houses, etc., we all know that the values change depending on the market, but the value that's recorded in your accounts is based on the actual price you paid at a certain date, and that's why we talk about it as being historic costing. Okay, so the next one is to do with the matching principle. Now, the matching principle is more about making sure that if you have an income coming in, what we want to be able to do is match the cost of that item in at least the same financial period. So if you've bought, I don't know, a television, let's say a television, or you're selling televisions but you've also bought them. So basically what we're trying to do is in that financial year, you're getting whatever your sales proceeds are, but it's matched with whatever price, and try to do it as much as specific, the specific item that you have, that person has bought. Because obviously if you're a TV provider, you will buy TVs at different times and there might be different prices for those. So if I buy a television from you at the end of the year, but it might not necessarily be, you might not necessarily give me the most recent TV that you've had in, even though it's the same, if it's the same make and model as everything else, it'll be, potentially it could be the first one you ever bought, so it might be a different price. So it's about trying to match the proper cost with the income. I hope that's made sense. Okay, so then we've got the the full disclosure principle. Now, basically, that is really all it's saying is that we have to disclose everything that is relevant to the business, and it has to be reliable information. That is basically what the full disclosure means. It's actually why the practice of having extra notes in the account has come about, because it's giving more information and more detailed information about what's in your balance sheet and profit and loss. They're giving more of a breakdown, more of a time period that relates to them, etc. So it's kind of trying to give more of a transparency, more of a larger picture, full disclosure. That's what full disclosure is all about. Okay. And then the last one is the objectivity principle. Basically what that means is everything needs to be able to be proved. So that's where the kind of evidence and documentation comes in. You try to prove that it's at an arm's length cost that you've bought stuff or sold stuff, because it's got to be objective. The pricing has got to be objective. So it's trying, so as an accountant, or more as an auditor, but as an accountant, because the auditors and the company, the government are all wanting it to be objective, arm's length pricing, so that you're kind of like, especially if it's something like, I guess this would probably rely more if you're spending, let's say you were spending grant money or something, and you're buying from your brother. Well, you might charge 3,000 for it, but at an arm length contract, you would only have spent 1,000 or 2,000. So you've kind of really, that would be a situation where you've got to be absolutely sure that you've got evidence that it's an arm's length transaction. So that's where it's got to be an objective price. Okay, I hope that was a little bit of use. So as I've said, my name's Morag and I run Northwest Numbers Limited, and I provide I can provide 30-minute free consultations. You can contact me through my Facebook and book that, or you can get in contact with me through my email, accounts@northwestnumbersltd.co.uk. I also do these 3 minutes with Morags three times a week at 1 o'clock on Tuesday, Wednesdays and Thursdays. As I say, this is where I try to simplify and demystify accounting terms and processes, so that it's easier for the non-accounting, non-finance people to understand. Okay, I hope I've achieved that objective today. Take care, and I will talk to you tomorrow. Bye.